Basic Appraisal Principles, page 184, Unit 3, Legal Considerations. The limited partners in proportion to their ownership interests. A limited partner holding a 10% interest in the partnership would be expected to pay personal income tax at his or her tax rate on 10% of the partnership profits. A limited partner has no ownership control over partnership property. Just like in general partnership, the partnership property is controlled by the general partners. Joint ventures. A joint venture is a partnership created for a single business transaction. It is not intended to be an ongoing business of indefinite duration. Joint ventures are generally governed by the same rules as partnership. For example, a development corporation and a construction corporation form a joint venture to purchase and develop a 40-acre parcel of land. The developer and the builder would share in the costs of development and in the profits from lot sales. Corporations. The most sophisticated form of business association is the corporation. Corporations are composed of individuals who are empowered to conduct business as one artificial person, the corporation. The corporation is a separate entity from its stockholders. It is capable of perpetual existence. The death of stockholders does not affect its operation. A corporation's income is taxed separately from the incomes of its stockholders. This double taxation is sometimes seen as a disadvantage of corporate ownership. The advantage of a corporation is that the stockholders' liability is limited. For example, a corporation is sued. It loses the lawsuit and must pay damages. The stockholders are affected because the value of their stock may go down, but the stockholders are not individually liable for damages that must be paid. The corporation, not the stockholders, owns the corporate property and controls the day-to-day business. A corporation is run by its board of directors and officers. When a corporation wants to buy or sell property, it isn't necessary for all the stockholders to sign the documents. The action must be authorized by a resolution of the board of directors. Someone in the corporation, such as the president or chief executive officer, is given authority to act for the corporation. A title company will usually require proof of authorization by the board of directors before ensuring a transaction. For example, a corporation is buying property. It is not necessary for every stockholder to sign the purchase agreement. The board of directors authorized the CEO and the corporate secretary to sign it. When an appraiser is handling an appraisal assignment that involves a corporation, the appraiser should know who is authorized to act for the corporation and whose signatures are required on the letter of engagement. Churches, fraternal, page 185. Organization, businesses, and even private hunting clubs are often owned by a corporation. Extra notes. Money put together for a business. Artificial person. Tax advantages. Stockholders, double taxation. Limited Liability Company, LLC. A limited liability company, LLC, is a comparatively new form of business organization. It combines many of the advantages of a corporation with many of the advantages of a partnership. In terms of management, an LLC offers the same flexibility as a general partnership. Certain members may be appointed to manage the company, or all of the members may manage it. All managing members can bind the LLC by their actions. However, in contrast to general partners in a partnership, managing members of an LLC are not personally responsible for the company's liabilities. LLC members have the same type of limited liability enjoyed by a corporate stockholders or limited partners, regardless of their level of participation in the management of the company. LLC members risk only their initial investment. At the same time, an LLC avoids the double taxation that corporations and their stockholders are subject to. Like partnership income, income earned by an LLC is taxed at only one level, as the personal income of each member. All property of an LLC is owned by the LLC itself rather than by the members. To transfer LLC property, an authorized managing member usually must sign the documents. A trust is a fiduciary relationship in which an entity holds title of assets or money for the benefit of another. Trusts are created for multiple reasons, such as for privacy, to avoid probate upon death, tax reduction, streamline process when assets exist in multiple states, ease of transferability, and more. The following are some key terms when referring to trusts. Trustee is an individual or corporation who holds legal title to property and manages the assets. Beneficiary is an entity for which the trustee manages the assets. Receiver of the benefits. And lastly, the trustor is the original party who created the trusts. Extra notes. More advantages than partnership. The LLC is new, avoids the double taxation. It's like protection from ourselves, separate entity.